Thank you so much for being here this evening. My name is Jordan Ben-Shia. I'm the Executive Director of the VIN Foundation, and this is the Repay Wiser webinar, choosing the best student loan repayment strategy for your situation. I'm going to go over a few housekeeping rules. Or housekeeping tips rather. So one of the most important things is that we really encourage questions. Dr. Bartels is happy to answer them. We will be answering them throughout the webinar if they're pertinent to the information he's sharing. And if we don't get through all of them, we will do some at the end of the webinar, and then also we will follow up with blog posts for the questions that were not answered. And that are also relevant for multiple people. So you will notice that there is a Q&A section at the bottom of your screen of the Zoom webinar. Please go ahead and put your questions in there. And you also have the opportunity to upvote, which means that if you like a question or you think it's important to you or it's relevant, that please go ahead and put it in there in the Q&A box instead of in the chat. That allows us to track it a little bit better and make sure that we get to all of them. Because you have all registered for this webinar, all of you will be getting a recording of this webinar, as well as a checklist with Repay Wiser tips and tools, and additional information on student loan repayment information and other helpful resources from the VIN Foundation. If you have any questions, we are here to help. We are a nonprofit. All of our resources are free. Whether or not you're a VIN member, we are just here to help. And you can feel free to email studentdebt@vinfoundation.org. You can see that email right there on your screen. So studentdebt@vinfoundation.org with any questions that you might have. And I'm going to, at this point, turn it over to Dr. Tony Bartels. One more thing, sorry, is you will all be receiving an email, as I said, with a recording that will come within the next couple days, as well as with additional information. So just give us a little bit of time to work on the video once it's done, and then we will be sending that your way. And without further ado, I'm going to introduce Dr. Tony Bartels. He is a VIN Foundation board member and an authority on student debt. He has a lot of information and a lot of experience, and if you haven't met him yet, you probably will, hopefully in your future. And I'm happy to turn it over to Dr. Bartels.
Great, thank you, Jordan. And thanks for that introduction and giving everybody the lay of the land. I do just want to reiterate a few things that Jordan said. It's definitely encourage questions. I've seen a couple of them come in already, so that's great. If you have any questions as we're going through some of the material, I'm going to illustrate some tools that we've built to help you understand student loans and the best way to choose a repayment strategy for your situation. And I may not be using numbers that necessarily match your situation, but if you have a simulation you want me to run while we're here, please feel free to volunteer that information while we're doing that. I am going to ask you some poll questions. I have about 6 polls tonight that will ask you for some information. A lot of those are going to happen in the front end here, just so I know a little bit more about you and I can better address some of this information to make sure that I'm catering it specifically to some of the situations that we actually have for the folks who have joined us tonight. Jordan also mentioned that I'm a bit of an authority on student debt, and that's mostly because I have a lot of student debt and I married even more student debt. So that may even be the situation for some of you all on the call. And the reason why we're doing this one, particularly this Repay Wiser webinar tonight, is because this is the time of year where those of you who are in repayment are likely either renewing your income if you're using income-driven repayment, or you've been in repayment for a year or a number of years now, and this kind of signifies the time of year when you would have started repayment, right? So this is about the time where the new graduate veterinarians are ending their grace periods and they are choosing their repayment plans. But this one is more targeted towards those of you who are already in repayment and you want to do a check-in, see if you're still on the right path, or how you know if you're actually using the best repayment strategy for your situation. So with that, we'll dig in a little bit deeper. All right, so this is really kind of your annual physical. Think of it like that, right? And this is kind of the 21st century student loan requirement, right? So there's no real set it and forget it situation anymore, particularly when it comes to veterinarians. Many of us graduate with student debt totals that exceed what we earn, at least in that first year, if not still. And that means that paying under traditional repayment plans can be quite challenging, right? So if you're using income-driven repayment or you want to learn more about it, you're in the right place, right? Because we're going to talk a lot about that, because that tends to be some of the better repayment strategies, particularly when your student debt exceeds your income. But there's a lot of work that comes along with those income-driven repayment plans, right? So that's why I call them annual physical exams. We do need to provide updated income documentation, and we need to make sure our loan servicers are processing that correctly. So there's a lot of stuff that has to go right in order for all of this to work out the way that we expect it to work out. So let's do a physical exam. We'll talk about the various treatment options that are out there. There's definitely some side effects. I'm sure some of you have experienced the side effects already. And then we'll talk about just some prognosis and really get into your questions for your specific situations to see if there's anything that we can do to alleviate some of the stress around paying your student loans and get you on a better path. Before I ask you some questions about your situations, I'll tell you a little bit about mine, right? So when I have people that come to me and ask for assistance on their student loans and repayment strategy, we do treat these like medical cases, right? So we do a lot of this on VIN in the student debt folder, or we do it through Foundation. And again, so everything starts with a history and signalment, and then we do a physical exam. So here's my history and signalment. We're a married 2-vet household with no kids yet. We do have a couple of Labradoodles, Maggie and Addie in the pictures there. We're recent CSU DVMs. My wife graduated in 2009 as an out-of-state student at CSU, and then went on to specialize in small animal internal medicine. I went the GP route, but I did a combined MBA DVM at Colorado State, graduated in 2012. I had some student loans from undergrad, so I was experienced with the student loan system. My wife had not. So her first experience borrowing was for veterinary school, and she was at the out-of-state rate at that time. But combined, we have student debt that exceeds $400,000, right? So I have about 40% of that. My wife carries about 60% of that. We currently manage that student loan balance using an income-driven plan called Revise Pay As You Earn, or Repay. And that's mostly because we don't qualify for Pay As You Earn, and we'll talk about those in a little bit more detail in just a few minutes. But that coming with, or using income-driven repayment, comes with one of the side effects is potentially forgiveness, so student loan forgiveness. So if you don't pay the balance before a specified period of time, you can end up hitting forgiveness and have to pay tax on the amount. And we're currently planning and saving for that, and we're about 50% of the way there in terms of our forgiveness plan, with about 18 years to go before we actually hit forgiveness. Right, so this is we're going to share a little bit about how this works practically, and I hope you'll share some of your concerns and experiences with this as well. First step, and we're going to cover this in a little more detail in the beginning part, just so everybody's on the same page, but in order to understand what we're dealing with, we really need to dig a little bit deeper into the student loans themselves. And the best way to do that, or one of the ways to do that, is through the National Student Loan Data System, so nslds.ed.gov. This is the official record for your federal student loan borrowing history. Not every loan is going to be in there, but most of the loans that we see for veterinary school will be in there, but we'll come back to that. And then we have a tool that I'll show you on VIN Foundation, where you can start to then make some sense out of those student loans. All right, so now I want to ask you a little bit about when you graduated, right? So I'm going to release a poll here that you all should see. Give me 1 second, right on the screen over here. So you should be seeing a poll asking you about your graduation year. Please answer that. This will help me understand. It's amazing how much we can learn just from your graduation year in terms of the plans that you're likely eligible for. But then the National Student Loan Data System will help us fill in those details. I'll give it another 10 or 15 seconds on the poll here. See, some people are still answering. I'll go ahead and end that. All right, and I'll share the results with you. So you should see that it looks like a majority of you graduated between 2012 and 2017. which is good information to know. You're going to be right on the cusp of qualifying for pay as you earn. So a lot of you probably will, which is great if you're not already using that. If you graduated before 2006 or between 2006 and 2011, you're not going to qualify for pay as you earn, right? But that leaves you kind of in the situation that my wife and I are in, where you'll have some of the other options available. So income-based repayment or revised pay as you earn. And then I'm not, must have missed a question there. I'm not sure how I ended up with the question in the poll, but great. That is very helpful. Thank you for answering that. All right, so now we're going to get into some more of the nitty gritty. Your student debt totals. Of course, this is really the meat of it. Great, you all are answering that one fast. Have that information at your fingertips. That's great. You have to usually coax it out of the students, but once you're in repayment, people tend to know what that number is a little more readily. All right, we'll end that one there. Okay, so it looks like we've got about a third of folks are in the 100 to 200,000 range, 27% in the 200 to 300, 20% in the 300 to 400. And then we have some tails at the lower and the higher ends, right? So this really mimics the distribution of some of the data that we see from the AVMA. So that's great. We've got a pretty representative sample of all the student loan totals that we see in veterinary medicine here tonight. All right. And then this is going to be the last one for a minute. And we can't talk about debt without talking about your income. So we do need to know generally what your income ranges are, because that's really what helps us determine which repayment plan we should be focusing on is our debt to income ratio, right? So we know the student debt number. Now we're going to talk about the income number, and that's really going to help us understand which repayment strategy to go with. Excellent. Thank you again for answering those questions so quickly. So another great distribution here, right? We see kind of the third there, the majority. That's right around what we see reported by AVMA as well. I do see some numbers at the higher end, which is great. And that's another reason why I wanted to do this tonight, is because those are some of the questions that I'm getting from veterinarians out there now are, you know, I'm earning more than I have ever earned. Should I change the way that I'm paying my student loans? And that's really what we want to focus on tonight. So that's good to see. Okay, so let's get into the physical exam. So first we need to look at our loan types. A lot of you are going to be familiar with that, particularly if you're already using an income-driven repayment plan. We definitely, the amounts you've already volunteered, but it's always good to check in and make sure we're not missing anything. And then our interest rates, right? So what is that weighted average interest rate of our loan portfolio that we have, our monthly payment, and then also the terms and conditions if we have some loans that might not fall into the federal student system. So first, just to get everybody on the same page, some federal student loans, the types of federal student loans that are out there, at least the ones most commonly used for veterinarians, are direct loans. If you graduated or attended school around 2010 or earlier, you might have some federal family education loans, or FEL program loans are referred to. Perkins loans were flying around there until recently, so some people might still have those. Health profession student loans and loans for disadvantaged students are also some federal student loans administered at the school level. If you have some private student loans, some loans that don't fall into that federal student loan realm, you're going to find them via your bank institution or the lender that you use to to borrow those. And if you have an online account, you can usually get the statements or the master promissory notes for those particular loans. The National Student Loan Data System is going to cover direct loans, FFELS, and Perkins loans. All right, so let's take a peek, or let's just go over there really quickly. So in case you've never been to this before, or you're not sure, it's been a while since you've borrowed and you just want to learn more about the plans that you're eligible for, this is the system that contains all of your federal student loan information. You may, if you haven't been in school in a while, if you remember the PIN that you used to use to apply for federal student aid, that's what's going to get you in here. Right, so if you haven't been in here, or you don't have a username and password for the FAFSA system anymore, then you may need to create one. And once you have that login information, you can click on this My Student Data Download button, and it'll generate this ugly looking text file on your computer that will have all of your federal student loan details baked into it. If you have private student loans and you don't know exactly who they live with, you can always check a credit report. So annualcreditreport.com, you can get a free credit report from the 3 major reporting entities once per year. And that's a good habit to be in anyway. I mean, you want to check and see what's on those credit reports. It's a measure of all your outstanding balances, and it also lets you know if somebody's tinkering around on there that shouldn't be. So when we talk about identity theft, that's usually how you can identify those sorts of things, is by checking your credit report. So that's a good habit to get into, especially if you're going to make a major purchase, buying a home, buying a car, buying a practice, any of those types of things. You want to know what's on that credit report before your bank finds out, because they're definitely going to check it. And if you're even considering a private loan refinance, I mean, you're going to want to know what's on that credit report as well, because that's one of the major items. Your credit history is going to really determine what kind of offer you can get on a private loan refinance. If you have some loans that are outside this federal student loan system, you may have to just add them to a spreadsheet to account for them. We are working on a way to help you add some different types of loans that are not in the NSLDS system. But tonight we're going to talk a lot about time-driven versus income-driven repayment, right? So that generally breaks down into 2 categories, ways that you can pay back your student loans. So time-driven repayment is the one that we're usually most familiar with. It's what I call traditional repayment plans, right? So these are, basically you have your principal balance, your interest rate, and some length of time that you agree to pay back your student loans, and that's what determines your monthly payment, right? So a standard 10-year plan is a good example of that. So a standard 10-year plan is the default repayment plan for federal student loans. So once you graduate, and if you don't choose a different repayment plan, they'll put you in that standard 10-year plan, and that's determined based on how much you borrowed, the interest rates that you borrowed at, and what it would take to pay that loan to zero in 10 years or 120 monthly payments. So that's how they determine the payment. You can extend it out for federal student loans. You can pay them back 15, 20, 25, even 30 years, or even under a graduated scheme, which basically has you paying the interest in the first couple of years, and then it increases every couple of years thereafter. Private student loans operate on time-driven repayment plans as well, right? So really the only difference is it's not a federal student loan. They may alter the repayment terms, so you might pay 12 years or 17 years or 8 years or something like that, but it's the same concept. So your payment is going to be based on the interest rate, the balance, the principal balance, and how long you agree to pay back that student loan. Federal student loans.
A quick question here about that. Sure. What do you consider a good interest percentage, or how low of a percentage is feasible, do you think, of those?
It really, so for interest rates, the federal student loan interest rates are determined by a formula set by Congress, right? So there's really, they're about as low as they can get right now, but they're determined based on when you took the loans. So whatever the prevailing interest rates in that formula dictated at that time is going to determine the federal student loan interest rates. And that's going to be some of the information that's in the National Student Loan Data System. For private student loans, the interest rates are a function of the interest rate environment that we're in right now, which is extremely low, right? So there are lots of low interest rate loans available out there, but it also depends on your credit score in terms of whether or not you can obtain an interest rate that's that low. And there's a lot of other things that go into that. Your credit score is just one of them. Also the amount that you borrowed and your income that you have as well is going to be part of that equation. But we'll talk about private loans in a little more detail a little bit later on. Actually, I want to go here and I'm going to illustrate what you can do with that National Student Loan Data System. So once you have this file, so if you click this button and you download that NSLDS file to your computer, you can head over to the VIN Foundation Student Debt Center, specifically vinfoundation.org/my student loan. So this is the VIN Foundation Student Debt Center. And you're going to find a box here that's going to match one of your circumstances, right? So this webinar tonight is geared towards those who have graduated veterinary school. So you're going to upload that NSLDS file. I'm going to go in here and I'm going to use an example one. So I've got a 2015 grad from Oklahoma State. So this is going to basically make sense out of all of that information that's in the National Student Loan Data System. And it's going to start to tease out some of the information that we find to be particularly important. And one of the things that I often see with recent graduates is that, one, you have some great ambitions to pay your loans off as fast as possible, but then sometimes reality gets in the way, right? So maybe your income doesn't go as far as you thought it would, or your student loan balance is a little bit higher and the payment is a little bit more than you would expect it to be. And then you stumble on, or you start reading about these income-driven repayment options, right? So how do you know which ones you qualify for, right? And we have that algorithm built in. So if you can obtain your National Student Loan Data System file and put it in here, we can tell you which income-driven repayment plans you're eligible to use based on the loan types that you have and when you started borrowing. And we can see here that this person graduated in 2015 isn't eligible for pay-as-you-earn, right? So similar to my wife and my situation, but is eligible for revised pay-as-you-earn for most of the student loan portfolio, right? We can see that this is only covering 96%, which means they probably have a small FEL balance here. And FELs are not eligible for revised pay-as-you-earn, right? They're only eligible for IBR. So in this case, when and if this person is using, so they are using an income-driven repayment plan, right? Revised pay-as-you-earn, the direct loan balance will be in revised pay-as-you-earn, and the FEL balance will be in IBR, the original version. Right. So this is another common question that comes up, particularly for graduates that have FEL program loans, is how can I be in two different repayment plans, right? And that's because the FEL program loans do not qualify for revised pay-as-you-earn. You would have to consolidate those into a direct consolidation loan in order to get them to qualify for revised pay-as-you-earn. But there's a lot of side effects associated with that once you're already in repayment. Right. So check and see where you are in terms of which repayment plan that you're using, right? All of that information is in the National Student Loan Data System. It'll say what your repayment plan is. In this case, this person's monthly payment is zero, right? And we'll talk about that too. You can have a monthly payment as zero under an income-driven repayment plan. It still counts as a payment, which is also nice. One of the other great things about the My Student Loans feature here is that we'll calculate a weighted average interest rate for you. Right. So this essentially tries to make sense of all the chaos that's in here. We can see that you end up with a portfolio of loans, right? And all of them have very different interest rates. How do we treat that as if it were one loan, right? So we can come back up here and we can see that if we lump everything together, we have $285,000 of principal. We'll talk about unpaid interest in a little bit. Total owed is close to 300,000 with a weighted average interest rate of 6.42%, right? So this is where I can now use this information to start making decisions about, how much would I need to pay in order to pay this student balance down to zero, or do I want to compare that against an income-driven plan that has me looking at forgiveness? All right, so poll number 4. So after going through all of that information, tell me a little bit about your loan portfolio. So if we do have some people that have some private loans, we can make sure to address that. give this a few more minutes here. Try to get up to the magic number we've been to before. All right. Okay, I'll go ahead and end that. So most of you have all federal student loans, right? So 70%, 71% of you have only federal student loans, which I kind of expected, right? That's usually the way that most people finance their veterinary education. And then sometimes we'll see that people will have some private loans, usually that they've obtained during undergrad on their way to veterinary school, or maybe you've refinanced some or all of your loans already. Great, so that is definitely helpful. Thank you again. All right, so let's do our part of our physical exam here is let's check in on our repayment plan, the payment amount that we're making each month, and then make sure that we are using the most beneficially available plan available to us. So again, that NSLDS system is going to show you that. One of the other things that I commonly see is or are new graduates who are using repayment plans that are less beneficial than some of the other ones that they're eligible to use. So probably the most common example of that are people who choose repay over something like pay as you earn. Usually if you qualify for pay as you earn, that is going to be the most beneficial plan for you. So definitely upload your NSLDS, and a majority of you tonight graduated in a time frame where there's a very good chance that you do qualify for pay as you earn. So if you're using income-driven repayment and it's not pay as you earn, then you may consider switching to pay as you earn, or finding out how you ended up in the plan that you're currently in. One of the reasons for that is a lot of people, or just collectively, everybody tends to talk about these plans and call them income-based repayment. And unfortunately, that's the name of two of the specific plans, right? So if you tell your servicer that you're interested in income-based repayment, they may put you in income-based repayment, which may not be the most beneficial plan, right? So you would have to specifically request pay as you earn or revise pay as you earn over a plan like income-based repayment or IBR in order to make sure that you're using the most beneficial one. So again, that information's in the National Student Loan Data System. You can click on that My Student Data download. You can put it in the VIN Foundation Student Debt Center, just like I illustrated, and check that income-driven repayment eligibility tab. And you can also see the plan that you're currently using. I can't emphasize this enough. This is one of the reasons why we do this physical exam each time that somebody posts on VIN, and we go through the loan history and signalment and physical exam. It is quite frequently, almost half of the time, people have a misunderstanding of the plan that they're currently using. So make sure to double check that. You also want to know what that monthly payment is. It's going to show you that in the summary in the My Student Loans. If you're paying amounts above the minimum, that I'm not going to be able to tell that in the My Student Loans tool, but you can tell us if you're paying amounts above the minimum. And then we'll talk about whether or not that's a good idea. And then what other plans might you be eligible for, right? And that's going to be in that income-driven repayment eligibility tab. All right, so tell me a little bit about your current repayment plan. Great, see some good information in here. Stuff I would not have expected. Okay, excellent. This is some excellent stuff here. So, all right, so half of you are using income-driven repayment, paying the minimum. Great. So some of you are paying more than the minimum. We're going to talk a little bit more about that when we get to using the simulator, and whether or not you should pay more than the minimum if you're projected to hit forgiveness. There's at least 15% of you that are using time-driven repayment in some form. And then 5% of you in deferment or forbearance, right? And we're going to talk about deferment and forbearance as well. So I don't know if you're interns or residents or what the situation is there, or maybe some other situation where your income is low or zero for the moment, but we'll talk about how to handle those strategies as well. Okay. So let's get to the diagnostic. So we've done a good job of the physical exam. You've shared a lot of the information that I need to kind of cater this going forward. And then we need to really start to apply this stuff. So what do we do with that information? So first thing we want to do is a math check of your current payment, particularly for those of you who are using income-driven repayment. Loan servicers make mistakes all of the time. And it's because that calculation that they use, which we'll go over in a second, is can be a little bit squishy, right? It's not always that straightforward. I mean, the math itself is simple, but how they choose to interpret the rules sometimes isn't favorable for you. So we want to first do a math check and make sure that what we're currently paying is what we expect to be paying. And then we want to, if we're not using income-driven repayment, we want to compare what our income-driven payment would be versus what we're currently paying, right? And this would be applicable for those folks who are potentially using a time-driven payment. And we want to compare what your current time-driven payment is against what it would be if we base it on your income. And then also looking at some of the other eligible repayment options, and if there's some way that we can maybe lower that monthly payment to free up some cash flow. So how do they calculate your payment? Under income-driven repayment, they use your income, and particularly they use a measure called discretionary income, right? So, and here's the different formulas for discretionary income. So 10% under some of the newer plans, right? So that's generally the most favorable. The lower the percentage, the lower the payment's going to be per month. And some of the older plans, 15 and 20%, not usually so helpful, but can be in certain cases. So your taxable income less an allowance, they subtract off of that, right? So they're going to take your taxable income and multiply the federal poverty guidelines for your family size by 150% and subtract that off to get the discretionary income, right? So this is what I mean when I say it's a pretty easy mathematical equation, right? Everybody can do this pretty quickly. And here's an example. So let's say we have a family size of 3 that has a combined household taxable income of 120,000. Right, so for a family size of 3, the federal poverty rate is 21,330. So they're going to multiply that by 1.5, subtract that from your taxable income, and come up with this discretionary income number. So 88,000 is the discretionary income. We can use that then to calculate what the monthly payment should be. So if we're using pay-as-you-earn or revised pay-as-you-earn, then we're going to take 10% of that discretionary income and divide it by 12 to get a monthly payment. Right, so that's $733 a month. Right, so everybody here can do that pretty quickly, right? You can fire up the calculator or pull out your smartphone and just use the calculator function, right? So put in some guesstimate of your taxable income. You can use this table here based on your family size. Put that in and see if the payment that you're coming up with is accurate based on what you're currently paying, or if it's higher or lower than what you should be paying. I did see a question in there about being married. We're going to cover that in a second. But so one of the common questions is, is there a magic number I should pay toward my student loans each month? And there's not really a magic number, but there is a magic percent, right? So how much does your income require? And the reality is here with the income-driven repayment options and 70% of you who have all federal student loan balances, you don't have to pay more than 10% of your discretionary income, right? So that's kind of the floor, if you will. So is your current payment more or less than that? And if you're currently paying more than that, then you may want to think about not paying more than that, right? Because you don't have to pay what you're currently paying, and you could free up that cash for some other things, which we'll also talk about. So taxable income, that's a bit of a loaded term, if you will, right? So we're not talking about gross income here, right? So your taxable income is usually your gross income less any kind of benefits that you might have, right? And if your employer provides a 401k plan or health insurance premiums that partly come out of your paycheck, or even a health savings account option, right? All of those types of things are not taxable income. So you want to make sure that you're, one, taking advantage of those if you have that available to you, and then subtracting those amounts off of your gross income to get to a taxable income, right? So that a lot of people I see provide their gross income in some way to their loan servicer, and they're happy to use that as your taxable income. They'll use that in the absence of anything else, but that tends to overestimate your monthly loan payment. You can always submit a tax return, right? So your AGI, your adjusted gross income from a tax return, that's kind of the gold standard. They'll always take that. And you can do that through studentloans.gov. As long as your most recent tax return is a reasonable representation of your current income, right? So if it is, then that's the easiest way to submit your income documentation to your loan servicer, is directly through studentloans.gov, using your most recent tax return. If you're going to do the pay stub, then you're going to have to do some math for them and write them some notes, right? So your pay stub, you got to make sure you understand how often you're paid. Semi-monthly and biweekly are not the same thing, right? So make sure you know how the frequency that you're paid and the number of paychecks that you receive per year, right? So that will help you determine or estimate an annual taxable income, accounting for all of those pre-tax deductions, right? So 401k contributions, health savings accounts, health insurance premiums, any other types of non-taxable items that are contained in your pay stub. All right. So what about marriage? I know that I saw some questions in there.
Yep, there's one specific question. Do you want me? We can wait till you're done sharing this part.
Yeah, sure. Let's kind of go through the basics first, but it's complicated, right? So first question, and when it comes to student loans, is are you married, right? So that's just, I mean, yes or no, right? So and that's what the application is going to ask you. Are you married? Yes or no. And if you check yes, then they're going to potentially want to see your spouse's income. Does your spouse also have federal student loans, right? So in my case, like what I call the double debt household, right? So I'm married to another veterinarian, has more student debt than I do. She also has federal student loans. That because we file our taxes jointly and use revised pay as you earn, her student loan balance gets factored in to my monthly student loan payment, right? So they will factor that in, and they'll apply that payment proportionally, right? So they're going to essentially calculate a combined household income using that discretionary income calculation, and then they're going to apply that payment proportionally. So I think I shared with you earlier that my wife has about 60% of the household student debt. So 60% of the total payment goes towards her student loans, and about 40% goes towards mine, right? So we can see some situations here, and I see them all the time, where, you know, if you have a spouse who has significantly more or significantly less student debt than you do, they can receive sometimes a benefit from the fact that you also have student loans, right? So that actually can help make it free up more cash flow and make it more obvious that you should both be using income-driven repayment, particularly if you both have federal student loans. If you do also have the option, if you're married, to file separately from your spouse. So, and if you do that, you can only provide your income if you're using pay-as-you-earn or IBR. Revised pay-as-you-earn, even if you file your taxes separately, does not allow you to separate your income from your spouse, right? They're still going to ask you, in order to complete the application, for a spouse income documentation. The only exception to that is if you're separated or going through a divorce or some other situation where you otherwise don't have access to your spouse's income. But generally speaking, revised pay-as-you-earn doesn't allow you to separate your income from your spouse. It can make sense for those households who, if you are the only one that has the student debt and your spouse does not have student debt, then it may make sense to file your taxes separately. You may pay a little bit more in taxes doing that, but you're probably going to save a lot more in your monthly student loan payments and total repayment costs. So that's going to be the exercise that you're going to want to go through, is how much am I going to lose in tax benefits versus how much am I going to save in student loan repayment costs. So an accountant is really helpful in helping with the tax part of figuring out how much taxes you may pay by filing separately. And they may even think you're crazy for wanting to file your taxes separately. But that's where you're going to go to something like the VIN Foundation Student Loan Repayment Simulator and quantify the difference, right? So you're going to want to show the accountant, well, look, if I file my taxes separately and we only base the payment on my income, I could save potentially hundreds of thousands of dollars on my student loans, right? And then your accountant will get on board, right? But you're going to have to be able to demonstrate that to them and yourself, right? Jordan, let's go back to that question. Did I answer the question on marriage through that?
You did. It was just
Okay.
sort of what's beneficial separately or jointly.
Okay.
And so you answered it.
Yeah. And it may change from year to year, right? It really depends on the specifics each year. So one year it may make sense to file jointly, the next year it may make sense to file separately, right? It's just part of this annual physical exam exercise to go through the numbers, look at your student loans, look at your taxable income, and see which one makes the most sense. All right, so how long will you be in repayment, right? And this is another common misconception I see out there, right? And a lot of this, and I've got some quotes that I've collected along the way that I just think are kind of funny, but also illustrate some of the points that I want to make here. There is a defined amount of time that you're going to be in student loan repayment, and it really depends on the way that you choose to pay back your student loan. So again, we're coming back to this income-driven versus time-driven difference in student loans. The income-driven repayment plans have defined maximum repayment periods, right? So no matter what your student balance is, once you start that clock ticking, so once you start using income-driven repayment for the first time, you're working towards that maximum repayment period, right? So for Pay As You Earn or the new version of IBR, you can only be in repayment for 20 years once you've started, right? Revised Pay As You Earn, IBR, old version, is 25 years, right? So these are the maximum amount of times that you can spend in repayment. You'll either pay your student loan balance to zero because your income has determined that it should, right? So your income climbed high enough and generated a payment that paid the balance to zero before you reach the maximum repayment period, or you reach that maximum repayment period and that's what triggers forgiveness. Either way, you'll be done paying back your student loans at that time. Right? So that's where it conflicts a little bit with this idea that I want to pay off my loans as fast as possible. We need to really define what is as fast as possible. And I think that last comment there where it says quickly or over 20 years, right? That's hard for me to make sense of, right? Quickly, what does quickly mean? Is quickly or over 20 years? I mean, does that mean that 20 years is acceptable? And if that's the case, great, we've got a way to do that, right? The time-driven plans, and one of the problems with some of the time-driven plans that we see, particularly with veterinary-sized student loan balances, is that you often have to extend them to 15, 20, 25 years in order to get a manageable enough monthly payment. And when that's the case, now you're bumping up against the same time periods that we have for income-driven repayment. And if you end up hitting forgiveness, we tend to see that it can end up decreasing your repayment costs quite a bit versus a time-driven plan, right? So the time-driven plans are really, you're basically the agreed upon terms determines how long you'll be in repayment. So whether you took out a private loan for undergrad or you refinanced them after veterinary school and you decided we're going to pay these off in 15 years, I mean, you have a contract that says that's what's going to happen, right? You're going to have to pay those loans off in 15 years. Otherwise, you'll be in violation of that contract, right? And your principal, your interest rate are largely going to determine what the payment is in order to do that. Under the income-driven plan, it's really a matter of how much does your income require you to pay and what balance is or is not remaining at 20 or 25 years, right? So this before I die, before I'm 80, if you live an average lifespan, right, you're not going to be in repayment forever. And the maximum amount of time that you would be in repayment for here, at least under the income-driven plans, would be 25 years. This is where we can start to run some simulations and see what that looks like. So let's go back to, actually, let's take a peek here. So here's the one that I uploaded before, right? And if you guys want me to put some different numbers in here to mimic some of your situations to make it a little bit more personable to you, just let me know. But I'm just going to use this to illustrate how this can work. But once you've uploaded your National Student Loan Data System file in here and you've got your summary, we know here that this person is using revised Pay As You Earn and has a little bit in IBR. we're going to send this information over to the loan repayment simulator. So we'll carry over that information. We'll say, so they've been in revised pay as you earn for about, let's say 3 years, right? So we can account for that, right? This is one of the huge functions of the VIN Foundation Student Loan Repayment Simulator. I've yet to see any other calculator out there that actually accounts for the time you've already spent in income-driven repayment, right? Even the Department of Education one doesn't allow you to do that. So this will count that time and will recognize that. And now this person's forgiveness clock is 22 more years from this point. Here we need to make some assumptions about the income. I'll put in kind of an average of what I saw tonight. You can change this year by year into the future for up to 25 or 30 years, or you can assume a rate of increase, right? So right now, I mean, we do see veterinary salaries increasing a little bit beyond the rate of inflation. It depends on kind of where you are in your career and where you're practicing, the type of way you're paid, right? So if you're paid on production and, you know, you have a pretty healthy service offering that you're doing there, you may, you know, see this number go up even faster. This is where we can start to add information about spouses, right? So if you're married currently or not yet, so maybe you're engaged and you know you'll be married in the next year or two, you can fill that information in there. If you have dependents or you want to have kids in the future, all of that is going to impact your family size, right? Which dictates the discretionary income, right? So that's why we have to ask that information in these, and why it's important is that will ultimately impact your total loan repayment costs. If we leave that out for now, we can start to see what these simulations look like, right? So we can start to look at the costs, start comparing them against each other, right? So immediately I see here, I got 22 years left. I'm probably going to have something forgiven. I can see how much I'm going to have forgiven. Total amount, about $390 forgiven there. I have to assume a tax rate on forgiveness, right? And then here I can see that, to me, this is one of those situations where I call a no-brainer, right? It is actually less expensive for this person to pay based on their income versus trying to pay it off faster, right? And this is something that we commonly see in income-driven repayment, is that paying less has us paying less in total versus trying to pay the balance to zero, right? And we do have to contend with this forgiveness, right? So how am I going to come up with this $117,000 that I need 22 years from now? And we take a stab at estimating that for you, right? You would need to stash away $313 in an account for the next 22 years, presuming you haven't started any kind of forgiveness plan yet, and you would have enough on hand to cover that tax 22 years from now when it occurs, right? So even accounting for that, so roughly $600 a month plus the $300 a month for your forgiveness plan gets you to a $900 total monthly student loan strategy, right? That's a lot less expensive than trying to pay it to zero faster than your income will likely allow you to do.
We have a couple questions about this.
Sure.
So one, just you answered a little bit of it, but what's your time frame for managing the risk on your forgiveness planning? I.e., are you investing it now and slowly pulling it over 10 years into liquid assets?
Yeah, that's a great question. We're going to talk about forgiveness planning towards the end, but I can tell you a little bit about it now. I mean, so yes, right now I've got my forgiveness plan is kind of aggressively weighted, I would say. It's more exposed to equities and more aggressive investments. And when I get to the point where I am comfortable with the amount that I need or I'm projecting to need for forgiveness, then I'll start to wind that down, right? I'm not going to leave that forgiveness plan subjected to a higher volatility stock market investment portfolio and a higher risk portfolio when I have the amount that I think that I need, right? So yeah, I will likely wind that down or change it to a much more conservative allocation once I reach the amount that I need. But the good thing is I have 18 years remaining, right? So I have time to weather some ups and downs. So that's the benefit of being ahead of schedule on the forgiveness plan, right? So I see a lot of people that, This just came up recently. There's a recent graduate that has a $0 payment similar to the one that I showed you, that I uploaded here, but really wants to pay more, right? It can't stand having a $0 payment, even though they went back to work since they established that $0 payment, and they can. But that's an opportunity to really maximize the rest of your financial wellness plan, including your forgiveness plan, right? Use that flexibility to bolster that forgiveness plan, so you'll hit your targets sooner than you're anticipating, and then you don't have to worry about how I'm going to wind it down immediately as I'm approaching forgiveness. But we'll come back to that. That's a good question.
You kind of covered this a little bit, but somebody asked, how do I deal with sort of the mind over matter about your balance growing?
Yeah, that's another one. We're going to cover that one later. I call that traumatic statement syndrome. But yeah, okay. and I just keep running simulations, right? I keep running simulations, and I keep looking at the rest of my financial wellness plan, right? I can grow the other areas of my finances. I can grow my net worth greater than I can if I try to pay down my student debt balance and sacrifice all of those other areas that allows me to grow my net worth, right? So yeah, it is something you have to contend with. And in this case, we can see that, right? And this is illustrated in these graphs here where, that one's not showing for some reason, but we do see that revised pay as you earn under the orange, that loan balance is growing, right? So that is a difficult thing to contend with. But the numbers show, even though the loan balance is growing, the numbers show that we're going to save a significant amount of money, and we're going to free up a significant amount of cash flow in our monthly budget by paying based on our income.
There's a couple questions about refinancing. Do you want to wait to answer those as well?
Let's hold off on those for just a few minutes.
Okay. Got it.
Thank you. All right, so time driven, and because I'm gonna show you this too, because one of the reasons why we don't have kind of a basic loan calculator on the VIN Foundation Student Debt Center is because they're all over the internet, right? So you can find these, calculating a monthly payment for a regular loan, a traditional repayment plan, is not hard, right? And there's tons of calculators out there. Here's one of them that I love, Bankrate. Like, they've got tons of resources for all this types of stuff. But if we put in, right, that same, and this may even cover some of those loan refinancing, but here we're dealing with about $300,000 of student debt, right? And I think a lot of people have a misunderstanding about what a private refinance is going to offer them. So right now we know that we have 22 years left on that particular example to pay back that student debt, even though we're going to hit forgiveness. Under a private refi, there is no forgiveness, right? There's no forgiveness option. So you're going to have to figure out a way of paying this balance to zero in some specified amount of time. Private loan refinances are very difficult to get in excess of, I would say, 20 years. Pretty rare that you ever see one that's even close to that, right? Usually they try to keep you in a 10, 12, 15, 17 year range. Rarely they'll let you go to 20 if you have a cosigner and you're married to somebody that has a significant earning potential. But even if we look at that, right? So if we refinance that, and let's be really generous, right? So the interest rates are really low, although it's really hard to get a really low interest rate on a high student loan refinance. This is still a hefty monthly payment, right? $1,600 is still $900 more than we calculated paying based on our income, even factoring in our forgiveness plan, right? So just because you can lower your interest rate and refinance it and pay it back under about the same amount of time, you're probably still going to end up paying more than you would have to under a income-driven plan, right? So total principal pay in this instance, even refinancing this at half the interest rate, so 3%, 20 years, we end up paying about $400,000 in total. So if we come back here and look at our forgiveness planning module, that's still $100,000 more than we had to pay using the current plan that we're using, right? So you have to be really careful, right? I mean, a private loan refinance, and now, especially now, right? I mean, this is when you're going to get confused the most by these private loan refinance people, is because interest rates are at historic lows, and they love to flash that around. But this is beyond interest rates, right? The types of numbers that we're dealing with and the options that you have available to you go way beyond interest rates, right? So you just have to know how you can compare those. And this is just one example of how you can go back and forth between the student loan repayment simulator comparing income-driven repayment against what you might be able to get under a private loan refinance. All right. So next step is calculate your student debt to income ratio, right? So take your student debt, your total student debt, and divide it by your income, and that will give you your student debt to income ratio, right? And that's going to fall along this spectrum somewhere. And what we see, and this is experience now running thousands and thousands of these simulations for our veterinary colleagues, right, is that usually your income-driven repayment monthly payment amount won't approach what a standard 10-year amount is until your debt to income ratio is 1 or less, right? That's when you want to think about starting to switch gears, right? So when, again, I know it's a great time to be a veterinarian, and a lot of veterinarians are earning more than they ever have in the past, but until your income exceeds your debt and you're pretty confident that it's going to stay there for the duration of your student loan repayment, that's when you switch gears, right? When you're when you're greater than 1, definitely when you're greater than 2, income-driven repayment is going to consistently show you that that's the least costly way to repay, and it's going to give you the most cash flow flexibility. You may see, as you're in this gray zone, somewhere on either side of this 1.5 range, where your income-driven repayment simulation may actually be greater than what it would be under a standard 10-year. But that doesn't mean you shouldn't use income-driven repayment. It just means that you want to assess your financial plan, look at the difference between what it would require you to pay a standard 10-year or a refinance amount, and see how much cash flow flexibility you have and how many other financial goals you still have on your list to achieve, right? Because it's hard once you lock yourself into a payment that's more than 10-12% of your discretionary income. It's harder to meet some of those other financial goals because your income is already spoken for, right? It's already accounted for in either that a more aggressive repayment strategy or that private loan refinance. So it really depends when you hit this gray zone. Maybe you're married and your debt to income ratio would be way less than 1 if you factor your spouse's income and you just want to pay your student debt balance 0. Great, right? But make sure you've gone through this math exercise to determine that. If you think that, or maybe you're married and you're the primary income getter and you are going to have some kids and your income is going to take a hit because you're going to be on unpaid maternity leave, right? Well, now your debt to income ratio may push up a little bit closer to 2 if you're currently in the gray zone. In that case, you want to maintain the flexibility that you have with income-driven repayment to have that payment lowered and not have to punish yourself to figure out how you're going to make that payment while your income's lower, right? So those are just a couple of examples of why it depends, and you can model those using the loan repayment simulator to see what that will do to your total repayment costs. All right, treatment plans. So what is the best way? I've kind of focused on, this is the theme for at least the last couple of months. This question keeps coming up. What's the best way to repay your student loans? And best is really a very subjective term. I really like to use the math to help make the decision here. But the math, in particularly when it comes to federal student loans, gets really distorted. And we do see this really unique instance when it comes to student loan repayment, where the best is not always the fastest and the fastest is not always the cheapest way to pay back your student loans, right? And this is a very, very unique situation when it comes to federal student loans, right? So it kind of blows up that whole concept that you need to pay everything off as fast as possible and throw as much money at it in order to save yourself the most money in the long run. It just isn't true. And that's really the income-driven plans and the forgiveness that distorts it all. So here's how I define best when it comes to a student loan repayment strategy. The first thing I want to do is reduce the risk to myself and my family. I'm going to go through that in a little more detail, but then I want to maximize my monthly cash flow, right? I don't want to pay more than my income requires towards my student loans because there's way better things I can do with my money than to give it to the Department of Education, even when they're not expecting it. Or to a private lender, right? Just because they flashed a fancy low student loan interest rate by me, right? So there's a lot of other things you can do with your money. And I do want to reduce my total loan repayment cost as low as possible, right? And we're going to talk about those here. So really this all comes down to, in my opinion, risk mitigation. Having debt puts you at risk, right? There's no doubt about that. There are consequences if you can't maintain at least a minimum payment on your debt. And being able to mitigate that risk reduces the likelihood of you experiencing consequences associated with not being able to pay your debt. Right? But the federal student loans come with a whole bunch of insurance that are baked into them that really help with this risk mitigation. Right? So not only can anybody or everyone look up what the terms and conditions are for all of the federal student loans, and everybody has the same ones, but they have some extremely favorable provisions in there. One of them worth noting is a death and disability discharge, right? There's no, if the worst should happen to you, and it sucks you have to even talk about this stuff, but we do have to consider it, right? If the worst should happen to you, your family is not on the hook for your student loans, right? In any way, shape, or form. That is spelled out in the federal student loans, is spelled out in the tax code. There is nobody on the hook for your federal student loans. You do have access to the income-driven plans that we've been talking about, loan forgiveness, public service loan forgiveness, which we haven't even talked about. All of those are options to help you mitigate against a decrease in income, or if you chose a career where you're taking less income just by virtue of the type of work it is, right? So if you're a state veterinarian, or maybe you're working for a shelter or some other focus that has a lower than average salary, right? The federal student loans will actually give you the benefit of public service loan forgiveness in order to account for that. So those are things that are not available with private student loans, right? They have very variable terms and conditions. A lot of this depends on your ability to negotiate with these companies whose this is their primary product, right? Is selling private student loan refinancing services or products, right? They're very good at this. And there's a lot of federal student loan money out there that they would like to get their hands on, which is why you get a dozen of them in the mail every week, if not more, right? I mean, I probably get more than a dozen offers to refinance my student loans in the mail every week, right? And they all, none of them have the types of provisions that the federal student loans have baked into them. Right? They have less favorable hardship and discharge provisions. They may even require a cosigner in order to get the lowest interest rate available, and that can be a disaster, right? So if you put your spouse, your parents, somebody else on the hook for your student loans, and that worst thing should happen to you, now they have to pay those loans, right? There is no discharge under that circumstance unless you are able to negotiate it. And as we illustrated previously, even if you get a lower interest rate, you may still end up paying more and reducing your cash flow, right? So you've still increased the risk to yourself, even though you've decreased the interest rate, right? So again, it goes way beyond interest rates, and that's just one illustration of that. I talk a lot about cash flow. You can do better things with your money, right? And for some of you, you get to a point where it's like, wow, I never thought I would earn this much, right? And that's great, right? But it doesn't mean that just because you have student debt, that all of that extra income should go towards that student debt. There is an amount defined that you have to pay, and that's defined by your discretionary income and your family size, right? So those income-driven repayment kind of sets the floor. So I like that measure, that 10% of your discretionary income. I love that measure as how much I should be targeting to pay towards my student debt. And if I have extra left, I'm going to first pay down less flexible debt, right? So credit cards, other less flexible private loans, medical debt, anything else that falls into that category. Start or build an emergency fund, right? So 3 to 6 months of your income is a target that I like to work towards. But if you have an emergency fund, then you don't need to carry credit card debt, right? And that will help you avoid some of those other types of debt that can be very difficult to get out from underneath and can negatively impact your credit score, like credit card debt. Maximize retirement funds. I see tons of veterinarians, even if they have access to a 401k, which is pretty rare, but increasing, right? So, but they're not taking advantage of those things because they want to pay more towards their student loans. And I just, don't leave that money on the table, right? Take advantage of those 401ks. In many instances, if you're doing the traditional 401k contributions, those are pre-tax items, right? So now you're reducing your taxable income, which reduces your monthly student loan payment. You'll have more money in retirement. You'll have a higher net asset or a net worth, and you'll also reduce your student loan repayment costs, right? So take advantage of all of those options that you have available through your employer. Insure yourself and your family. Again, these are things that, help to reduce the risk to you and your family if something should happen or interrupt your ability to earn an income. If you think you're going to hit forgiveness, and this is where the student loan repayment simulator comes in, if you constantly keep bumping up against a forgiven amount and you have to plan for it, then start planning for it, right? Time is on your side the longer it is between now and forgiveness. Use that time to your advantage. You can save for a home, a family, a practice. All of these things are doable if you have the cash flow to support it, right? And one of the ways to do that is by not paying more than your income requires toward your student debt. So yeah, your student debt does not have to prevent you from adulting, right? That's another. Who is the? Recently, there's been a run of people on VIN who have been posting that they're having their first kid, right? And inevitably they come to the conclusion that who knew that kids were so expensive, right? And yeah, that's a true statement. So they're even more expensive if you don't have the flexibility to pay less towards your student loans than, particularly if you're paying more than your income requires. And one of the reasons I love, these income-driven repayment plans is my payment tracks my income. As my income goes up, my payment goes up. Right? Some people are freaked out by that, but let's be real here. If your income went up, great, congratulations, right? But you're still paying the same percentage of your income as you were before, right? So that's a good thing. Right? If your income goes down, your payment goes down, right? Same thing, right? So if my payment goes down because my income went down, well, now I don't have to, wonder how I'm going to make ends meet. I'm still paying the same percentage of my income towards my student loans, right? So I don't have to hit the freak out button if I'm transitioning between jobs or I go on maternity leave or whatever the case is. Your payment is always that known percentage of your taxable income. We've already covered this. Really, the student loan repayment strategies go beyond the interest rates, right? And I think one of the things that is hard for people to wrap their head around is that these income-driven repayment plans have very ill-defined costs. It depends on our ability to project in the future what our incomes are going to do, right? And that's very difficult, right? But you get into a pattern, and for many of you that have been out, you kind of have an expectation of what your income is going to do, unless you're going to radically change gears, right? If you're going to, go from GP to emergency practice or vice versa, right? I mean, you may see kind of a dramatic jump in your income one way or the other, but you can still account for that, right? So your payment's still going to be that percentage of your income, and then it may impact whether or not you're going to have some forgiven or more forgiven. The time-driven plans, they do have well-defined costs. People do like that. They like that comfort of being able to pay the same monthly amount each month and know that that loan balance will be zero at some date. The problem is a lot of stuff happens between that time and that some date, right? And it may not be conducive to making that payment if your income were to be interrupted for some reason. So run the numbers, see which one is going to be most beneficial for you. The income-driven repayment plans, the loan repayment simulator, and the VIN Foundation Student Debt Center is going to be the best tool for that. And then there's a myriad of calculators all over the internet that'll help you calculate monthly payments on loans, no matter what the interest rate is. I did see in the poll, and that was one of the things that surprised me. For those of you that are using income-driven repayment, paying more than the minimum, right? So another reason to do this annual physical, right? So run your simulation, put your best guess of your income in there, your family information in there. And if you're bumping up against forgiveness, it doesn't make sense to pay more than the minimum, right? You'd be better off paying the minimum and planning for the forgiveness. You'll free up the most cash flow and decrease your total costs the most. For time-driven plans, the only way to decrease the costs is to lower the interest rate, pay more, or decrease the time that you're in repayment. None of those things are very favorable unless you have some pretty robust or increasing income. And again, now we're talking about incomes that are exceeding your debt, right? And if that's the case, again, congratulations. You can definitely explore some of these private loan refinance options or time-driven repayment options in order to do those things to decrease your costs. But you'll probably be punishing yourself if you're not quite to that point yet. I do want to cover the effective annual interest rate, right? So this is another way that you can measure the impact of forgiveness. So it really requires us to define interest, right? What is interest? And essentially it's the cost above what you've borrowed. So here I have a simulation, and let's kind of come over here, and this is one that I saved. After you run a simulation in the loan repayment simulator, you'll have an option here to save your simulation, right? So you don't have to go back and put those inputs in there again. You can copy this link and save it, or email it to yourself, or send it to me if you have questions about it. And this is a great way for me to kind of see what it is that you're looking at and help answer your questions when it comes to your specific simulations. But here's one where we have a little bit lower student debt total using pay as you earn. I think I have this is the average salary for 2018 graduates in small animal medicine, as reported by the AVMA. And when we come down to the total, right, here's a perfect illustration too. Here I can see, and this person qualifies for pay as you earn. Pay as you earn is actually more than the standard 10-year, right? But that doesn't mean that I should start using the standard 10-year, because look at the difference between the monthly payments, right? Or $1,500 different. That's a significant amount of money, right? I can do better things with that $1,500 that are going to more than eclipse this small difference between the total pay as you earn cost and the standard 10-year cost, right? So just to highlight that. But we do also have to factor in forgiveness here. So if I hit forgiveness under pay as you earn in this case, I need to save $72,000, which means I need to save about $220 a month for the next 20 years. If I do that and my total costs are $263,000, I borrowed initially $185,000, right? So $263,000 minus $185, that's the interest that I've paid in total over those 20 years. If I annualize that, that comes out to an effective interest rate of 2.12%, right? Even though my stated interest rate is 5.75%, if this simulation is in the ballpark of what I end up paying, I've effectively paid 2.12% in interest per year, right? And that's what you can use. Somebody else asked about, how do I combat that? My loan balance keep growing. This is the same thing. In this situation, the loan balance continues to grow. But I know that if it pans out this way, that I've paid 2.12%, I can do a lot better things to try to earn more than 2.12% on that additional cash flow I have using income-driven repayment. And that's what the effective interest rate calculation is all about. And here's the math for that, right? So we borrowed $185,000, we paid back $263,000. We have the difference there is $78,000. We divide that by what we borrowed. That's essentially the proportion of interest we paid. And we divide that by the 20-year time frame to get the annualized effective interest rate. All right, so side effects, you've already touched on some of them, right? So this negative amortization, that's the loan balance continues to grow, right? Then we have capitalization on top of that. And that really is a function of this unpaid interest. So you can have a situation under income-driven repayment, and many of you may be experiencing this now, where the monthly payment is less than the interest that accrues, right? So that means the loan balance grows. So income-driven repayment allows unpaid interest, but you're still considered to be current and in good standing on your debt, on that particular student debt. You are also not charged additional interest on that unpaid interest, right? So that is a huge factor, and one of the reasons why we see these simulations often show income-driven repayment to be less costly than paying under a standard plan, is because this unpaid interest doesn't cost you any additional interest. Under time-driven repayment, unpaid interest isn't even allowed. You are not allowed to pay less than the interest that accrues each month, right? So that's another good measure that you can use. If I'm going to use a time-driven plan, what's the minimum amount of interest that accrues each month, and can I continually afford that? If you have any hesitation at all, then you want to lean against that time-driven plan, right? Because if you don't make the payment, or at least cover the interest, right, that's what they consider to be default. Right? So that is the definition of default, is not covering the interest of what you owe the bank on your debt. That will negatively impact your credit and increase your costs over time, right? But income-driven repayment allows that situation to happen, and you're also considered to be in good standing. So making payments based on your income, even if it doesn't cover the interest, can actually help improve your credit score and also make you a better borrowing candidate for things like a home or a practice or other major purchases that you might be pursuing, right? So another plus for paying based on your income versus trying to pay more than your income allows. You can have situations where that unpaid interest will capitalize, right? So capitalization is the adding of unpaid interest to your principal balance. And these are some of the triggers for that. I mean, your goal is to keep that unpaid interest off of your principal balance, right? So keep it from capitalizing. The three most common things that I see causing capitalization is, once you're in repayment, is probably failing to renew your income-driven repayment on time, right? So I already talked about this earlier. This requires a lot of work, right? Every year, at least every year, you have to provide updated income documentation. And if you don't provide the right documentation and your servicer doesn't process it on time, they will take your unpaid interest and they will add it to your principal, right? And that will create this capitalizing effect, almost mimicking a compounding effect, which will increase your total student loan repayment costs. The other two that I see are changing repayment plans. Now that can make sense, right? So if you discovered tonight that you're using an old version of IBR and you actually qualify for Repay and you want to switch, that probably makes sense, right? Or maybe you started using Repay and you found out that you qualified for Pay As You Earn. You want to switch, that probably makes sense, right? So that's not, they will capitalize any unpaid interest that you have, but that, the loan repayment simulator will also account for that. So we can quantify whether or not that capitalization event should deter you from switching. But in most cases, it'll probably still support switching if you're switching to a more beneficial repayment plan. But you want to keep this plan switching to a minimum. Only if you're switching to a more beneficial plan that's going to lower your total costs or increase your flexibility. Changing loan status is another big one. That comes to the deferment and forbearance, right? So those folks that indicated earlier that you're in deferment and forbearance, get out of deferment and forbearance, right? So deferment and forbearance is really obsolete in the era of income-driven repayment. If your income is low, zero, residency, internship level, you can have a payment that's zero or mimics that low internship residency pay level. And it's better to have that tiny payment than it is to let that interest accrue and then have it added to your principal. Deferment and forbearance doesn't do you any good, right? It doesn't count towards forgiveness in any way. It just racks up that interest. And as soon as you end that deferment, it's going to add it to your principal balance, which means you're going to pay more over time, right? So get into income-driven repayment. Have your payment as low as it possibly can be based on your income at that time. Make those payments. You'll still accrue interest, but when you come out of that low income situation, it won't get added to your principal balance, right? So that's the benefit of using income-driven repayment over deferment and forbearance. Another common occurrence I see this happening, veterinary medicine is predominantly a female field right now. A lot of you females go on maternity leave, right? And sometimes that's unpaid. Oftentimes that's unpaid. You'll call your loan servicer. You tell them, look, I'm going on maternity leave. I'm not going to be able to make my student loan payment. They are more than happy to put your loans in a deferment or forbearance. That's almost a reflex for them, right? As soon as you call your loan servicer, they almost automatically offer you a deferment or forbearance, right? You have to be smart enough to tell them, no, I don't want that. I want you to recalculate my payment, keep me in income-driven repayment, and that will reduce your total repayment costs in the long term. So have your payment adjusted downward, resist that deferment and forbearance. Failing to renew, set your reminders. You should be getting reminders from your loan servicer when you're due to renew, but don't rely on those. I would have my own reminders. The system usually allows you to renew 60 days before your anniversary date, and you have to have that information in within 10 days of that anniversary date. Right? So, and submitting it is not good enough, right? You have to make sure that your loan servicer actually processes it and doesn't result, they have to process it on time so it doesn't result in a capitalization event. Most of the time, when I see, and I do these, when we do these on VIN and we do the physical exam of their student loans, I will see a number of capitalization events that most borrowers aren't even aware of, right? So know enough to know when capitalization has occurred. Some of the loan servicers will tell you or show you when that has happened. If you don't know why, or there wasn't a good reason for it, then you should be calling them and asking them why it got capitalized at all, right? Theoretically, your unpaid interest should never capitalize once you're in repayment, right? So if you're making a payment that's less than the income and you don't have, or less than the interest, and you don't have an unpaid interest balance, then something happened, right? They took that unpaid interest and they added it to your principal. Now you're accruing more interest. You need to find out why, right? That shouldn't happen automatically. Don't let them tell you that that happens automatically, right? It shouldn't happen at all if you're providing the income documentation on time and they're doing their job on time. So there is a intangible associated with this that I call traumatic statement syndrome. And we touched upon this earlier. And this is that frustrating reality that your loan balance could increase, and it may be increasing. It may never decrease until you hit forgiveness, right? And this really does some funny things to you. Again, there is no set it and forget it anymore. Not when your debt exceeds your income, right? It's just, there's too much at stake. Your finances are too precious, right? There's no reason to pay more than you have to. But watching your student loan balance go up, usually when I see this happen, another reason why we're doing this, right? 2, 3, 4, 5 years into repayment, you've watched that loan balance go up now for the last several years, and you just can't handle it anymore, right? That you say to yourself that there's got to be a better way to do this. I need to get these loans off my back. I'm going to open that SoFi letter or that letter from DRB or Citizens Bank that says I can get a 2.5% interest rate on my student loans. Chances are you're not going to, right? And even if you could, it's probably not going to save you more money, right? So resist that temptation, keep running simulations, find other areas to put the extra cash flow that you have from paying based on your income, and watch your net worth grow from those activities instead of paying more than you have to towards your student loans. That's where that financial wellness plan really comes in.
Tony, I'm just going to ask a question here because this is
Yeah.
probably in a lot of people's minds. Someone said, will the forgiveness option repayee affect my credit score at the time? My dad, a CPA, is convinced this option will cause my score to drop in the year my loans are forgiven.
Yeah, that comes up a lot. And I think that, and I think that is driven from those of you that have accountants in the family. And there is no indication that having a balance canceled, right, which is what they call it when it gets forgiven, and this is perfect timing with this. We're going to talk about the details of that. When a loan balance is canceled, it's usually canceled for non-payment, right? So this is not the same as that, right? So for you to have debt canceled, you have to usually be delinquent or in default on that particular balance. You are never in default or delinquency or anything that even resembles that under income-driven repayment. You are allowed to make these payments that are less than the interest and have your loan balance grow. So when the loan balance is canceled, it'll get reported to the IRS, but there's no corresponding default or delinquency attached to that, which means there would be no adverse effect to your credit score. The only way that there would be an adverse effect to your credit score is if you didn't pay the IRS, right? That would be a trigger for them to report you to the credit agencies that you're not making good on your debts, right? Strictly having debt canceled is not a reportable event. It's the stuff that leads up to usually having a debt canceled is because you're not paying it, right? But at that point, again, for anything other than student loans, that usually means you're in delinquency, default, maybe even bankruptcy, right? But you're not in any of those statuses when you're in loan forgiveness or when you're in for student loans, right? They're unique in that regard. So I'd love to hear your accountant family member's response to that, but I cannot find any indication that strictly having forgiveness happen on student loans is going to negatively impact your credit, as long as you pay the IRS.
Because what if I don't have the money to pay the taxes after forgiveness?
Yeah, so what? That's a big deal, right? And you don't want to have to be scrambling to figure out how am I going to come up with this amount to cover the IRS, because they're not going to let it go, right? So, I mean, you get the student loans canceled and the Department of Education, it's not their problem anymore, but now you have to deal with the IRS. So use the time that you have now to plan for that forgiveness, right? This is the benefit of having 20, 25 years to and to project what you think that forgiveness would be, is to save for it, right? And you may have to be more aggressive depending on how much time you have left or the amount that's going to be forgiven. If you don't have the amount to pay the IRS, you can always set up a plan with them, presuming you can find the funds to cover that. But in my mind, setting up a plan to cover the rest of your loans after you just paid your loans for 20 or 25 years sounds really, really less than enticing. So take advantage of the time available to you so you can pay, have that amount on hand. If the worst should happen, there are some insolvency provisions in the tax code, right? And I don't usually like to talk about these, but again, this question comes up always. Try to be prepared for the forgiveness, try as best as you can, but things may happen, right? That where you're just not going to have the funds. But if your liabilities exceed your assets at the time you hit forgiveness, then you're considered to be insolvent. If you can document insolvency, then you don't have to pay the tax on forgiveness, right? Now, that's not something anybody should shoot for, right? Nobody should shoot for insolvency 20 or 25 years after they graduate veterinary school. But if, you know, stuff hits the fan and you're in that position, there are some escape hatches out from underneath that tax, if need be. But this is, perfect timing, right? I mean, this is where we're at. This is the logistics. This is what we know is supposed to happen when it comes to student loan forgiveness, right? So you're going to make payments, and once you hit that maximum repayment period, you're going to receive a 1099-C, a cancellation of debt. Right, so that's the kind of like your W-2 summarizes all the earnings that you had for the year. If you have any cancellation of debt, you'll receive a 1099-C. And the IRS is very experienced in handling debt cancellation, right? So we've been forgiving debt for decades, right? And but applying it to student loans in this way is a little bit unique, right? So but we do have precedent for this. People's mortgage debt, medical debt, credit card debt gets canceled all the time, right? And those folks, usually they get that, are usually delinquent in some fashion. But the difference here is student loans, you're not going to be delinquent when your debt cancellation happens. Once that happens, you're going to have to report that as income on your tax return for that year. And whatever your marginal income tax rate is, that's what you're going to have to pay when you settle up with the IRS by April 15th of that following year, right? So that's the logistics of loan forgiveness. You don't have to apply for this type of forgiveness. It's going to be triggered by the number of payments that you've made under income-driven repayment, right? And your loan servicer should be tracking those. However, I would be requesting that. I do that every year that I renew. I ask Great Lakes and I ask Navient for the number of qualifying income-driven payments that I've made towards my student loans. And when they say, sorry, I can't produce that, I tell them, I read the rules back to them. You are responsible for providing this notification of the 1099-C. So they're going to have to be able to provide that information at some point. So they're getting there, right? They're getting a little bit better at it. I mean, I know I've received updates from you all on VIN that are doing that, right? So if we keep asking them to provide that documentation, they're going to have to get better at providing it, and they are getting better. And good thing is, we've got a number of years before somebody actually will hit forgiveness. They're going to have to get better by the time we all get there. All right, coming into the home stretch here. So prognosis, what's this going to look like? First of all, it's okay to make payments based on your income, right? So you're gonna get a lot of pushback on that, maybe even from your family members, particularly if they're a CPA, right? Or your mentors that you work with that may have already paid back their student loans from veterinary school, but they didn't have access to income-driven repayment, and they tell you that you're sucking on the teat of society or whatever the latest excuse is these days. They're just not familiar with the rules and regulations that are currently in place, and you don't have to pay your loans based on how they had the rules set up when they were paying back their student loans, right? Use the ones that are most beneficial to you. Loan repayment will end, right? You're either going to earn enough to pay your loans to zero, or you're going to hit forgiveness, right? So let your income determine that, or be prepared, right? Either is okay, right? Try to be prepared, run simulations, get an idea of how much you need to save for forgiveness, and start saving. And that's what we're gonna finish up with, really, is this forgiveness planning. So get started, right? I think there's way too much just analysis paralysis, right? I don't know how much I'm going to have, or I don't know what I'm going to do 20 years from now. I get it. It's hard to conceptualize what yourself is going to look like 20 or 25 years from now. But the earlier you get started, just like retirement, the earlier you get started, the better off you're going to be, the better your future self is going to be. Run simulations. We do have the forgiveness planning module. I've illustrated that a number of times tonight. Let's just go back, right? I got it handy right here. We're going to take a stab at this, right? And if you're, and we also assume some kind of return on this investment, right? You're not going to take this $219 and stick it in a coffee can or shove it under your mattress. You're going to stick it in something that's going to earn you a return. We riffed on that a little bit earlier, right? So 3%, it's probably a little, it's hard to get 3% right now because the interest rates have gone down, at least without doing anything, right? So, I mean, I've got some online savings accounts that are close to 2%, right? So you can see that if the interest rate goes down $244, it goes up a little bit, right? So the projected amount. But if you are more aggressive, right, because you've got more time in order to take advantage of this, it goes way down, right? But this is a lot riskier. What if the tax rates are higher? Right? We can play with that too. Let's bump it up to 35%. Or maybe you live in California or New Jersey or Illinois, and it's a high tax state, right? We have to account for state taxes in some instances as well too. You can account for that. Maybe I don't want to be that aggressive. I'm going to pick somewhere in the middle of the road. I'm going to assume a higher tax rate, and I come up with a target, an amount that I can, even if I can't afford this right now, at least I know what that number is. I can start contributing what I can afford and work up towards this, right? So take the analysis paralysis out of the equation. Go on bankrate.com, nerdwallet.com, look for the highest yielding online savings account. Set up some automatic transfers as much as you can afford, ideally maybe getting to that amount that is projected in the forgiveness planning module. When you have an uncomfortable amount in that online savings account and you're like, oh, what am I going to do with this? I feel like I should put this somewhere else. That's when you start looking for other things, right? That's when you start looking around. You can start applying some of those similar concepts to retirement savings. Again, we're talking about long-term time horizons here. Diversified investments are great. You can even look at target date funds or robo-advisors, right? So these robo-advisors, I love these things, right? This is like Wealthfront, Betterment, Acorns, all of these computer-generated platforms that basically use the data that's out there in the financial industry to say that if we take the people out of the equation, you end up doing better with your longer-term investments, right? And there's a lot of truth to that. Right? So you can take advantage of these things and they're super cheap, right? You just tell them what your risk tolerance is and they will set up the portfolio for you and they cost almost nothing, right? So it's never been easier to invest on your own, but if you're still not comfortable doing that, then look for a certified financial planner, right? CFP. That designation actually means something. It's the closest we can get to people that are supposed to act in your best interest and not their own. It's even silly that we have to talk about that, but the financial planning industry is rife with folks that love to recommend you stuff that lines their pockets is not necessarily a good idea for you, right? So look for CFPs. They're generally supposed to be a little better at that. If you're not sure, ask them if they're a fiduciary. That's the fancy word that means that they're supposed to put your best interests ahead of their own, right? And if they say no, or they give you a bunch of, well, then look somewhere else. Right. So, but the CFPs are really good at meeting targets, right? Especially if you know that I need 70, 80, $100,000 20 years from now, right? And this is how much I have to invest, and this is my comfort level with investing. That's where they shine, right? They can help you build a portfolio. You'll pay them for that, right? That's the fee only. They'll pay you. You'll pay them for their time, kind of like pet owners pay you for your time, right? So they have that knowledge and they can help you walk through that process. But be really careful about vomiting your entire student loan situation on their desk and saying, help me with this, right? Give them a specific target, right? And this is where you have to be really careful, because I spend a lot of time undoing a lot of the stuff that financial planners tell people about income-driven repayment, right? It's just because they're just not very well informed on these plans, and they tend to operate under some of these traditional financial recommendations that have you paying more than your income allows towards your student loans. The rare few out there that understand that, but I found that to be the exception and not the rule yet. So you have to be really careful. So what I like to do is use the accountants for what they're good at. They're really good at taxes, right? If you have questions about how you should file your taxes, if you're married, whether or not I should file my taxes jointly or separately, let them answer the tax question. If I have a long-term investment question about how am I going to save for forgiveness or how am I going to get there, that's where the certified financial planner can be really useful, right? So now you've got a couple of different people to help you. You've got the loan repayment simulator to help you navigate the student loan repayment costs of that, and you can give them their assignments, and then you put it all together, right? You're not going to find one person that's going to be able to do all of this for you. You may have to enlist the help of a few different specialists in the areas that they're very good at. All that said, when you get to forgiveness, that happens in a specific time, right? So you can use the retirement horizon and the concepts around retirement investing like we talked about earlier. I'm happy being aggressive now because I have 18 years before I hit forgiveness, right? I've got time to weather some of the ups and downs that we see in investing, right? But at some point, 18 years from now, I'll be knocking on the door of forgiveness and I'm going to need that money, right? I can't, like retirement, I can decide to postpone retirement, work a little bit longer, or adjust my my living based on what I have in order to retire. But when I hit forgiveness and I file my taxes that year, the IRS is going to want that outstanding balance by April 15th, right? I can't postpone that. I can't tell them, hey, this isn't a good year. Maybe we can do this next year, right? Again, that's all time based. It's going to happen whether you're ready for it or not, right? So better to be ready for it and not have your forgiveness fund still tied up in the stock market 2 years before you hit forgiveness, because if the bottom drops out, you may not have enough to pay the IRS, right? So be a little bit careful. The closer you get to forgiveness, you probably want to wind that down and put it into something that's much more conservative as you're knocking on the door of forgiveness. One of the things I wanted to put in here, I didn't get a chance to this afternoon, but what does that mean? What is forgiveness? What does student loan repayment look like? How do I know when I'm done with my student loans? And I've been thinking about this a lot lately as like I shared with you earlier, I'm 50% or a little bit more to where I think I need to be for our forgiveness plan. And when I get to 100%, at that point, in my mind, I'm done with my student loans, right? I am just managing them at that point. I'm still going to be submitting my income documentation on time and making sure I'm still on track. And I probably have very few tweaks to make unless we have a significant increase or a significant decrease in our income. And either one of those, hopefully we can account for. But once I get to that targeted amount, to me, that means I'm done with my student loans, right? I'm just managing them at that point. I'm still contributing that 10% or so of our discretionary income towards my student loans. Maybe I'm not contributing to my forgiveness fund anymore, and I'm redirecting those funds to some other area of my financial plan. But that's what loan repayment looks like being done for me. And I'm hoping to be there in the next maybe even few years, depending on what the stock market keeps doing. Right? We may be able to get there if we keep this run that we're on now. I may be able to get to that point in the next 3-5 years, and that would be outstanding, right? And then we can start redirecting some of those forgiveness funds somewhere else. I do have to follow the tax rates, right? Because that's one of the big unknowns. Is I don't know what the tax rates are going to be when I get there, right? But I do file my taxes every year. I check in with my accountant too. I'm going to know what my marginal income tax rate is, and likely there's not going to be any dramatic changes. If there are, hopefully we'll have some time to pivot and account for those as well. But I'll use my marginal income tax rate from the previous years to be a gauge for what I expect to pay when I do hit student loan forgiveness. All right, so last question here. Oh, sorry, let me go back. Oh my God, I hit the wrong button. Sorry. Thanks for sticking in here. Well, this is the question that keeps me up at night. So hopefully you guys are all gonna surprise me. So it's one thing for me to tell you how to do all this. And it's another thing to know if you're actually doing it, right? And I don't have a way of knowing if you're acting on your forgiveness plan or not, right? But that is one of the things that scares me most, is that I don't want to have anybody feel like they're going to not be able to make good with the IRS after showing them how they can free up some cash flow on their student loan repayment. All right. I'll end this, share the results with you. I mean, this is kind of what I expected, right? I mean, and that's fine, right? I mean, as we learn better, know better, we do better, right? So get started, start putting something away, particularly if you know you're going to hit forgiveness, right? So it doesn't mean you shouldn't start or keep trying to increase your income, and maybe you don't have to hit forgiveness, but if it's quite likely that you think you're going to hit forgiveness, start saving something, right? Because you'll be surprised at how quickly that can add up when you're taking advantage of some of these different options that are out there. All right. Coming to the end here. So what questions do we have that I have not touched on?
So let's start with, do you want to start with some refinancing questions?
Sure.
Okay. Will refinancing through something like Sophie knock me out of my IBR forgiveness?
Absolutely. Yes. So if you take and I'm sorry if I didn't make this more explicit, if you take your federal student loans out of that system, you essentially replace those federal student loans with a new private loan, right? So there's no way to go back, and there's no way to take advantage of those forgiveness options that we talked about tonight. So that is a definite consequence of private loan refinance.
Okay, what are the consequences of refinancing your loans?
Yeah, so here, this is, let me, in the WikiDebt section, so we do have some documentation in here. We have a document about student loan refinancing and things that you should consider. So this is a document that covers a lot of that, but the major consequences are you're giving up a lot of flexibility and insurance that you currently have through your federal student loans. And you may be able to get a lower interest rate for that, but that's probably not enough to account for all of the flexibility that you currently have, right? So until or unless your income exceeds your debt, I would be really reluctant to replace your federal student loans with a private student loan. It increases the risk to you and anybody that's in your family potentially when you do that.
Okay, next one is, how does refinancing affect eligibility? Is there a refinancing option for the forgiveness plans, or is it just continuing to pay the same amount, your best plan? Pay the same amount, your best plan.
How does refinancing affect eligibility? I'm not sure I understand that.
I think they mean for the plans available. Yeah.
Yeah. I mean, if you seeking out a refinance opportunity does not affect anything, right? You can always shop around, right? But once you refinance, again, it's not reversible, right? If you have a private lender like SoFi or any of the other ones that are out there, pay off your federal student loans, and now you're paying SoFi back, you are subject to the terms and conditions of that SoFi loan, right? So make sure you understand exactly what those terms and conditions are and what happens if your income should be interrupted for any reason, right? That is the biggest advice I can give on the private loan refinancing. That, and then comparing the cost using that effective interest rate that we illustrated earlier to see if it actually even makes sense to do so. Again, just because you can get a lower interest rate doesn't mean you're going to pay less towards your student loans.
Okay, this is a question we get probably every webinar, which is how often can you change your type of repayment?
Yeah.
For instance, if I choose a shorter payback time and it ends up not being suitable, when can I choose a new plan?
Yeah. So we covered that a little bit earlier, but try to keep the switching to a minimum. And again, I mean, you get a little bit like a broken record here, but if you have your payment set as a percentage of your income, there's really no reason to switch, right? If your income increases, your payment will increase the next time you renew. And if you could still afford to pay more or wanted to pay more, you can, right? There's no need to switch. And in the example that you gave that said, what if I wanted to start on a shorter time frame and then switch to a longer one because I'm not sure that I can maintain that, I would flip it around and do the opposite. Have your minimum payment based on your income. And then if you want to pay more, if you want to decide that you want to make a run for hitting loan balance zero because that's just what you have to do, then do it with the minimum set as low as possible. So if something does happen, you can always revert back to the minimum. It's a lot easier to say, oh, something happened, I had a car issue or unexpected health expense, and I'm going to be off of work for a couple of weeks and I'm not going to have any income. I want to go back to paying the minimum rather than saying to my loan servicer, oh, I can't afford to pay this now. What can I do? Right? So flip it around, right? Have the minimum monthly payment set to as low as your income requires. And then if you have to pay more from there.
Okay, so multiple people are asking this as we normally get these questions. What are the chances that any of these plans will go away?
Yeah, so what are the odds that pay is eliminated before the loans are forgiven? So slim and none, right? So you have a contract, just like you would sign a contract with a private lender that outline the terms. For them to change that payment arrangement for you would be breaking that contract. You are not the only ones that have those contracts, right? There's 44 to 45 million student loan borrowers. It is highly unlikely that they're going to break the contracts for those 44, 45 million student loan borrowers. All of the proposals that are out there now to change the repayment options do not apply to people that are in repayment or are currently borrowing. They're geared towards people who are not yet in the higher education system yet. So if and when we ever get a change to the Higher Education Act, it is more likely that they're going to set up a whole new repayment structure under a new set of student loans that those new people will have available to them. But it's not going to change the options that you have available or that you're currently using.
Okay, what's a good strategy for entering into repayment after 3 years of deferment for residency?
Same thing that we covered tonight. So best way is to first do your history, signalment, physical exam, download your National Student Loan Data System file, upload it into the VIN Foundation My Student Loans tool, look at the plans that you're eligible for, and apply for the most beneficial one. If you're eligible for pay as you earn, jump on it. Right? That's going to be your best and most flexible option. If not, you're looking at probably revised pay as you earn or IBR just to get started, right? And then see what your income is going to require you to pay after you understand a little bit more about what your income is going to be as a specialist, right? So maybe you'll get to a point where your income exceeds your debt, right? And you're only using that income-driven approach temporarily, and your payment will increase to something that approaches the standard 10-year. And if that's the case, then you can maybe think about refinancing at that time. But run the simulations to see if that makes sense. I still often see, even with specialists, right? We do this on the VIN student debt folder all the time. You know, specialists who are commanding some pretty significant incomes. But if your student debt balance is still 200, 250, 300, 350, there's a really good chance you're going to hit forgiveness, even with a specialty income. So run the simulations and take advantage of the lowest and most flexible, lowest cost and most flexible repayment option that you have.
Okay, a question about public service loan forgiveness.
Yep.
When using the regular public forgiveness plan, not the PSLF, sorry, and you say the forgiven amount is considered taxable income, will it change your income tax bracket? If you're normally in a 15% bracket, could forgiveness on a $300,000 loan throw you into a much higher tax bracket?
Absolutely. It absolutely can. And it depends on where the tax brackets are at the time and what your overall taxable income is when you file your taxes that year. It can definitely throw you into a higher tax bracket, right? So those are questions that I would be, and I'll start investigating with my accountant as I'm getting closer to forgiveness, right? I know about what that is now just by looking at the tax brackets. The top federal income tax bracket right now is 37%. So it can't be any higher than that at a federal level, right? But that's right now, right? And that also pretends that my income, my wife's income, and our student loan forgiveness push us into the highest tax bracket. And that's probably unlikely as well, because that highest tax bracket is going to be really, really high, right? And it's quite unlikely that we're going to be in that highest tax bracket. So, but it can push you into a higher tax bracket. It just depends on what your income is at that time, what the tax brackets are, and how much you have forgiven. But you can plan for that, right? And the forgiveness planning module allows you to plan for that as well.
Wonderful. Okay, so someone wants to confirm, if I'm working on public service loan forgiveness, I don't need to worry about the tax?
That is true. If you are, but I would double check, right? So there is a public service loan forgiveness employment certification form, right? If you're not filling that out every year, then start doing that, right? So you'll fill out part of it. Your employer fills out part of it. You're going to submit that to your to the Department of Education, and they're going to give you thumbs up, thumbs down. You're doing what you should be doing, and here's how many qualifying payments we have for you. This is how much longer you have before you can apply for forgiveness, right? So, and if you're working towards, and you think you're going to continue working towards public service loan forgiveness, then you don't have to save for the tax. Some people do, just because they're not convinced that they're going to stay in a public service loan forgiveness employment position for the duration, and that's fine. I mean, you can choose to do that too. But if you know that you're kind of a public service person and your goal is to reach public service loan forgiveness, then you don't have to save for the tax, because there's not going to be one.
Okay, how do we find out if our loans have been capitalized?
So check your loan servicer portal. Some of them will show loan capitalization and when they happened. But again, one of the easiest ways to tell is to first upload your student loan information into the VIN Foundation My Student Loans tool and look at your monthly payment versus how much interest accrues each month. If your monthly payment is less than the interest that accrues each month, then you should have an unpaid interest balance, right? If you don't have an unpaid interest balance, then there's a good chance that your unpaid interest was capitalized, right? So that's a tip off as well. And if you still want to dig deeper into that, there's some things that we can poke through in your National Student Loan Data System that will indicate when a capitalization event may have happened. And I'm happy to go through that with you.
And you can just email studentdebt@vinfoundation.org for any more specific questions. When you say call loan servicer to reduce income, if that should occur, when can you do this at any time during repayment, or do you have to wait until renewal?
Oh yeah, great question. So if you experience a reduction to your income, even before you have to renew, you can submit that request, right? They always have to process a reduction to your income, even if it's not within the annual renewal period. Now, if your income increases, they don't want to hear from you until you're in the annual renewal period, right? So these income-driven plans, and the spirit of them, if you read the language that are behind them, are really geared towards trying to keep you out of default and trying to make it easier for you to manage your student loans, right? So that's one of the reasons why they'll always process a decrease to your income, even outside of the renewal period, but they don't want to hear from you if your income increases before you get to the renewal period.
Okay. What qualifies as a disability in order to get a loan discharged?
Oh, that's a great question. That's tough to prove. There are some cases out there that, set standards, if you will, for that. But generally speaking, This is if you are injured to the point that you cannot earn what a veterinarian would earn normally based on whatever your disability is, then you probably have a good case for having your loans discharged. But you're going to want to visit with a lawyer who has some experience with attempting to have student loans discharged to pursue that, right? That's a pretty tough thing to do. But again, if you are can prove that disability, then I think then you do have a case to have those student loans discharged.
And I think we do want to take a moment to just say that we know that student debt can be extremely stressful, and the VIN Foundation does have a confidential support group called Vets for Vets, which is there for anyone if you just need to talk or feeling overwhelmed, and it is a free resource as well and available to everybody. Okay, next question. What are available options if separate private loans are consolidated, but that consolidated loan terms are not working for current financial situation?
Yeah, so this is one of the side effects of the private loans, right? So it's private loans. Once you have a private loan, you're subject to repayment under the terms and conditions of those loans. You can try to refinance those private loans with another private loan. But if your current financial situation is not optimal, it's very difficult to find somebody that's willing to refinance that loan at better terms and conditions than you currently have, right? So usually, and this is another one of the reasons why I really caution against private loans in general, is because when you need the relief is not the time that the private lenders are going to provide you the relief, right? So I don't have a very good answer. When your financial situation is not such that you can handle the terms of the current loan that you have, you either have to work to improve your financial situation or work with your current lender to see if they will allow some kind of deferment or some kind of alternate arrangement temporarily to help get you through that financial situation until you can get to a point where you can negotiate better terms. Otherwise, you're looking at visiting with a lawyer potentially. If you're already or you're knocking on the door of default, that is also a period where you may want to visit with a lawyer to see what your options are. But first thing to do would be to really dig in to the terms and conditions of the loan that you currently have and see what options are available for either reducing or postponing the payment. Maybe you'll get lucky and there was something in there that you can take advantage of temporarily. It is a great time to try to refinance student loans, but again, that assumes that you're in a financial position where you can obtain or convince a private lender that you are, a good candidate for that, right? Otherwise, there are no other options that I can come up with here. I wish you good luck in terms of doing that. And if you have any additional questions or you want me to kind of wade through that loan contract that you currently have with you to see if there's something in there that we can tease out of there, I'm happy to do that. But unfortunately, sometimes your options are limited.
Okay, if I'm applying for bankruptcy, if applying for bankruptcy ever becomes an option in the future for student loans, would this be a considerable option, especially if my forgiveness funds might be close to the original balance of the student loan I started with?
I wouldn't bank on that. So, and I've seen some, bankruptcy is pretty serious, right? I mean, and if you're in that situation, then yeah, maybe that's the best solution for you. But I don't know that we're ever going to see a point where student loans are eligible for bankruptcy protection. So I wouldn't count on that. Like I did discuss earlier, if you were to have an amount forgiven that exceeds your assets at the time forgiveness happens, then the insolvency provisions would actually protect you from having to file for bankruptcy. So you'd probably be better off in that instance to pursue insolvency versus bankruptcy anyway. So, I kind of look at the student loan repayment, I assign everything probabilities, and I tend to lean on what is currently written, right? Because as we've seen in this political landscape, it is extremely difficult to get anything changed. And the likelihood that anything that does get changed is actually going to be more beneficial for you is even less likely. So I tend to lean on what I currently know, what the contract says now. And if I'm presenting with some other information that will alter that greatly, then we'll be sure to be out here telling you about it, right? But I would not hope for something that currently doesn't exist. I would plan for what we know does exist. And then if the worst should happen and you need to pursue something like insolvency, let's look at that when that time comes.
Okay. Is it a good idea to have the lowest income possible the year of forgiveness so that the amount of taxes you pay will be less, since you have to account for the tax forgiveness added onto your salary for that year?
Yeah. So now we're talking about some creative tax planning, right? I think that's a great thought. I think, so 2032 is going to be the first year that we see people appreciably or a high number of people actually experience student loan forgiveness. So right at that point, we'll start to get a better flair for the type of things that are available. And at that point, or right around that point, I'm assuming we're going to have some tax accountants that are going to be noticing that, hey, here's a creative service that I can offer some people to help them reduce their tax on student loan forgiveness. But yeah, absolutely. I mean, depending on what you're looking at, I don't know if it's going to warrant enough to, not have any taxable income that year. But yeah, I mean, you generally want to try to reduce the amount that you're paying in taxes every year anyway, right? So, I mean, you can take advantage of some of those opportunities now. You don't have to wait for student loan forgiveness to do that. So, but yes, I do agree that when you start knock on the door of student loan forgiveness, there may be some creative ways of decreasing that tax depending on your current situation.
Okay, I think we're almost done here. Are there loan service providers for federal student loans that are considered better versus others? Your opinions here.
Yeah, well, I got to be careful with this one because I talk about this a lot with students. But unfortunately, when you're in repayment, I don't like to talk about it too much because it requires you to consolidate your loans using a direct consolidation loan in order to switch loan servicers. And it's probably not a good idea to consolidate your loans in the middle of repayment because you're going to forfeit all of the time that you've spent towards forgiveness. And that's probably not a good enough reason to switch loan servicers. But yes, some of them are much worse than this than others. Navient is terrible. There's no two ways about it. If you have Navient, you just have to be really careful. You have to scrutinize them more. Again, this is why we do these things so frequently and we make them available for you to listen to, and you can email us and ask questions. They're terrible at this, right? So they make a lot of mistakes. They tell you a lot of inaccurate or just flat out false information. So my goal is not to make everybody a student loan expert, but I do want you to know enough about your student loans that you can protect yourself against the loan servicers. And Navient, Nelnet, they're two of the worst, right? So the only way for you to get away from your current loan servicer is to consolidate your student loans. A direct consolidation loan allows you to choose your loan servicer. But once you're already in repayment, especially if you've already been using income-driven repayment, I would not recommend that, right? You do not want to give up that time that you've already logged towards forgiveness. You don't want to start that clock over, no matter which loan servicer you have. If you have a terrible one, you just have to be more diligent about doing this. The other kind of backdoor way is if you're potentially working towards public service loan forgiveness or have the opportunity to, when you submit that employment certification form, they will automatically move your loans over to Fed Loan Servicing because they are the official loan servicer that monitors progress for that program. That's another way to get your loans away from Navient or Nelnet, but it does require that you're able to show that you're working towards public service loan forgiveness. Another point on that If you think you're working towards public service loan forgiveness and your loan servicer is not Fed loan servicing, then you need to make sure that they are, right? Because that means that you haven't documented that proof with the Department of Education that says that they know that you're doing that, and you and them are on the same page, right? So if you think you're working towards public service loan forgiveness and you still have Navient or Nelnet as your loan servicer, then you need to take a second look and find that employment certification form.
Okay, I think this is our last question here.
Cool.
Currently in IVR and engaged, but not sure can marry because then we'll consider my spouse's income, which is higher than mine. He does, in quotes, he does not have any student debts. Afraid my monthly balance will double and more money would go towards interest as we will still not even touch the principal balance.
Okay, yeah. So the should I get married conundrum. A couple of things that stand out to me in that question. You said that you're currently using IBR, right? And I just want to reiterate this again. IBR, if you're truly using income-based repayment, so IBR, one of the income-driven repayment plans, IBR is one of the plans that allows you to separate your income from your spouse. So if you were married and you filed your taxes separately, you don't have to include your spouse's income if you're in IBR, right? Make sure you know which repayment plan you're in, right? If you're in IBR, then I'm not too worried that your payment's going to go up just because you got married. But if you're in Repay, then yes, right? That we did talk about that earlier, where revised pay as you earn is a version of income-driven repayment. And when you're married, even if you file your taxes separately, they're going to require your spouse's income. So in that instance, your payment would go up. Now, you know, we can debate whether or not that's a reason enough to not get married. You could also, if you're using Repay now, switch from Repay to IBR or pay as you earn, ideally, if you had that available. Those plans do allow you to separate your income from your spouse. So that would be another example where I would say that's a good reason to switch, right? I'm getting married. I'm currently using a plan that does not allow me to separate my income from my spouse. And if I were to do so, it's going to benefit me financially. That might be a consideration for switching current plans. But first, let's make sure we know which plan you're actually using to know whether you need to switch or not. You may not even need to switch. You just may need to file your taxes separately.
Okay, I think that we have covered all 48 questions.
Great.
So I did, just so everybody knows, if you have any further questions, you can email studentdebt@vinfoundation.org. And as we mentioned before, we'll be sending out an email within the next couple days with a link to this webinar recording, along with the poll results. I know some of you had some challenges viewing the polls. And we'll also be sending out a Repay Wiser checklist, and you'll get additional information about student debt. And I'll let Tony finish with anything else we might want to say.
No, I'm just looking at the webinar chat, and I know that some people asked questions in the chat and not in the question thing, but we'll probably post some of these as part of the blog. There's a couple of good ones in here.
Yep, that was my thought, that there might be a little longer.
Yeah. What if there's one though that alludes that you don't have a contract with the federal government. You do have a contract, right? So the master promissory note, if you log into studentloans.gov, you can actually look at it. So when you log into studentloans.gov, you can look at the master promissory note, which is the contract that you signed when you took out your student loans and agreed to pay them back. It describes all of this in here, right? So I get the idea that, you know, something about this seems like they could just remove it, but it is way more permanent than you all give it credit for. So read those if that'll make you feel better. And if you still have questions about it, we can certainly answer those. And there was another one here too that seemed to freak out that, you know, you consolidated your loan several years ago to get a better interest rate, and that you don't have access to any of the stuff that we talked about tonight, right? And yeah, I mean, there's nothing I can do to undo that, but you can, you know, make the best of your current situation, right? So I mean, we're in an even lower interest rate environment than we were even 3 years ago. So you may be able to refinance those loans again at an even lower interest rate and maybe some more favorable terms, right? So we did talk about what you can do with private student loans, reducing the interest rate, extending the or shortening the repayment term or paying more will reduce the amount of time that you are in repayment, as well as decrease the total costs if your income allows for it. So don't freak out too much. Make the best of the situation that you currently have. If you still have more questions about those, feel free to reach out. We're definitely here to help you with that.
Absolutely. We're available for any other questions that you have. Student debt at vinfoundation.org. A couple people asked, all of these resources are free. You do not need to be a VIN member. They're all available to you at no cost. It's part of the VIN Foundation. And we mentioned about Vets for Vets as well. Information about that is on the vinfoundation.org website. And thank you all so much for being here. Is there anything else you want to say, Tony?
No, thank you, Jordan, for setting this up and moderating it and helping people with the questions and getting those out to me. And we look forward to doing more of these in the future and just trying to, it's going to be a long-term process. It's a marathon, not a sprint, right? So we're all going to be here to help you hopefully reduce some of the stress around this stuff and help you improve your overall financial health.
Absolutely. Thanks everyone for being here. Have a good night.
Have a good night.